In this video, we introduce Chapter 15, Stockholders' Equity. There are three primary forms of business organization, but we focus primarily on corporations. This is because in corporations, ownership is by shares of stock. And we see that here, ownership is by shares of stock. And it's the fact that those shares of stock can be exchanged between hands that leads the prospective shareholder or investor to want to have financial information about the company. Some other factors we want to know is that corporations are influenced by state corporate law, and there can be a variety of ownership interests. Typically, we talk about common stock, but there are other types of ownership interests. Let's write down a few definitions. Corporations must submit articles of incorporation. This is a legal document that states all the necessary information to file incorporation with the state. Once it is approved, the state issues a corporate charter or corporation charter that allows the company to legally run as a corporation. As you probably have heard, many companies get incorporation in the state of Delaware for favorable tax laws. And while most of the accounting for stockholders' equity is the same, as we'll see in this video, there are some minor differences in that can hold depending on the state that the company is incorporated in. Capital stock is the general term to cover common and preferred stock, but remember, most stock is common stock. If a company only issues one type of stock, it is common stock. And capital stock, unless in the absence of restrictive provisions, and preferred stock often has these restricted provisions. So in many cases, we're referring to common stock here when we discuss these rights of stockholders. 1, to share proportionately in profits and losses. 2, to share proportionally in management, but specifically, the specific type of management is voting rights, and those voting rights often relate to voting for directors. 3, the right to share proportionately in assets upon liquidation, meaning if the company goes into bankruptcy, after all the creditors are paid off, whatever remains gets distributed according to ownership to those stockholders. And finally, to share proportionately in any new issues of stock of the same class, and that's known as the preemptive right. What that refers to is if the company decides to issue new shares of stock, additional shares above and beyond what was issued, let's say, initially, then the existing stockholders get a say in if 100 new shares are going to be issued, those existing stockholders get the right to maintain their same ownership percentage. So if I owned 1/100th before, I have the option to buy one new share so that I can maintain the same ownership percentage once new shares go out to the market. So to share proportionately in any new issues, of stock of the same class. Maintain existing ownership percentage. And this is called the preemptive right. We've mentioned that there's a variety of ownership interests. Here's two major types of ownership. Common stock. Common stock is the residual interest in a corporation, meaning whatever's left over when that company decides to end its business, whether voluntarily or involuntarily, whatever is left over after all of the liabilities are paid, or in other words, all of the creditors are paid out, the remaining interest or the residual interest goes to the common stockholders. Common stockholders bear the ultimate risk of loss because, as I said, first, all the creditors are paid off. So if there's nothing left for the common stockholders, then they have nothing. And they know that when they enter into becoming stockholders and buying their shares of stock. The reason that they're willing to do this is because stockholders receive the benefits of success. They have the most upside potential. And then one more thing we want to know is that there are no common stockholders have no guaranteed dividends. Or assets upon dissolution. So when that company decides to end its life, voluntarily or interiorly, the common stockholders do not have any right, no legal right to get anything if there's nothing left after those common stockholders receive payment. Preferred stock is a special class of stock created by a contract in which stockholders sacrifice for certain rights in return for other rights. Normally, but not in all situations, but normally preferred stock does not have voting rights, but it has preference to dividends. But that's not always the case. The specific preferred stock might have specific claims to it in the contract agreement on that stock certificate. But generally, we say stockholders give up certain rights in return for certain privileges. And here we see a visual of stockholders equity section of the balance sheet. We see the two primary sources of equity, contributed capital and retained earnings, and we see that broken down. We see treasury stock, which we introduced very briefly in Intermediate 1. Since there's a lot of information here, let's work through this step by step. I like to always start with the accounting equation, assets equals liabilities plus owner's equity. And then let's break down stockholders' equity into its components. So this will look the same information as we saw before, but look just in a slightly different format. So the contributed capital is the general term for the stock that's issued to outside investors. And then the other main component is retained earnings. Contributed capital is oftentimes it's simply just common stock. But the company may also issue preferred stock as an additional type. We often see an additional paid-in capital account that's tracked. We'll see more about that in this video. Additional paid-in capital, the amount that the stockholders pay in above par value of the common or preferred stock. And from this, if a company issues stock and then buys that stock back out of the hands of the existing investors, we call that treasury stock, so less any treasury stock. Some things that we want to know about the issuance of stock, that you're probably familiar with most of these terms from earlier accounting classes. Par value, no par, stock issued in combination with other securities, stock issued in non-cash transactions, and the cost of issuing stock. Let's account for each one of these in the slides ahead. Companies often have a very, very low par value of stock. Many companies have the par value as 1 cent or sometimes a fraction of a cent. Years ago, the par value actually had valid meaning. Today, there's really very little meaning to the term of par value, but it does drive how we record our journal entries. The amount that the stockholder pays to receive their shares of par value stock above the stock's par value is called additional paid-in capital or paid-in capital in excess of par. Let's look at a journal entry. Blue Diamond Corporation issued 300 shares of $10 par value common stock for $4,500. Prepare the journal entry to record the issuance of these shares. So the company, we've done this before in Intermediate 1, you've done this in your Accounting 221 Principles class. The company receives cash equal to the, well, they're told directly here, they don't say the price per share, the market price per share. But we're told directly that the company receives 4,500 cash. And in exchange, the company gives up common stock at its par value, since there is a par value of $10 per share times 300 shares. So 3,000 is an increase to common stock. And then the difference between the cash received by the company and the amount of ownership that is given out gets recorded into additional paid-in capital common stock. or sometimes we call it paid in capital in excess of par value. So this is just simply the difference between the cash received and the par value of the stock. Stock can sometimes be issued as no par, depending on the state regulations, is what the state allows. And in that case, no additional paid in capital account is used. So real simple, we see this example here. Video Electronics Corporation issues, they're authorized to issue 10,000. They actually issue 500 shares at $10 per share. There's no par value to the stock, so we record the entire entry directly. The cash received of 500 times 10 or 5,000. Market price times number of shares to cash, and then because this is no par stock, it goes directly into the common stock account. Pretty straightforward. Sometimes no par value is given a stated value. In terms of accounting, a stated value really is no different than a par value. We still account for the amount that the stock sells above stated value, and we put that difference in an account. Instead of calling additional paid in capital in excess of par, we call additional paid in capital in excess of stated value, but the accounting is very similar. If a company issued 1,000 shares with a $5 stated value, market price of $15 per share, it makes the following entry. The company receives cash at market price times the number of shares. $15 market price, so 15,000. Since it does have a stated value, we act very similarly to this being a par value. And so in the common stock account, we record this at stated value rather than par value, which is the $5 stated value times the 1,000 shares. So common stock account increases by 5,000, and then we have additional paid in capital, again on that common stock, or we can credit an account called paid in capital in excess of stated value for the difference between the $15 market price and the stated value of 5. So $10 times 1,000, 10,000. Now, what happens in the situation where stock is issued with other securities? So company issues, let's say, common stock and preferred stock together for one lump sum price. Well, there's two methods of allocating the amount of cash that's received to each of the two different classes of stock, whether that be common and preferred. We use the proportional method when we can, and if we can't use the proportional method, we have no other choice, then we use the incremental method. Let's look at each of these two in the next slide. Beverage Corporation issued 300 shares of $10 par value common stock and or together with 100 shares of $50 par value preferred stock for one lump sum of $13,500. Common stock has a market value of $20 per share and preferred stock has a market value of $90 per share. Calculate the amount of cash proceeds that should be allocated to the common stock and allocated to the preferred stock. So the company has received $13,500 cash for stock that has a market value of how much? Well, the common stock, how much is the market value of the common stock? We have 300 shares at a market price of $20 per share. So the common stock alone has a market value of 6,000. What's the market value of the preferred stock? Preferred stock, the company has issued 100 shares of the preferred stock, 300 of common, 100 of preferred, and the preferred has a market value of $90 per share. $100 preferred shares, market price per share of 99,000. Okay, we sold $15,000 worth in terms of market price of stock for $13,500. So we know our journal entry is going to be cash increases $13,500, but by how much do we increase common stock and how much do we increase preferred stock? What we do, this is the proportional method, so we say common stock is what proportion of the total. So common stock is 6,000 over the total of 15,000. or 6/15, or 2/5. So common stock makes up 40% of the total, and therefore common stock is going to be 40% of this cash 13,500, which we'll see in a moment. Preferred stock, well, if we only issue two types of stock, right? So it has to come down to this 100%. So preferred stock must be the remaining 60%. Preferred stock is going to be 60% of 13,500. But how do we get that? Well, we say it's 9,000 market value over the total 15,000 market value. 9/15, 60%. So then the next step that we need to do is we allocate the issue price, the 13,500 issue price. We have common of 40%. So we take the 13,500 and we allocate 40% of those cash proceeds to the common stock. Say common stock goes up by a total of 5,400. How much would go to preferred stock? The remaining 60%, or 8,100. Now all we need to do is record the journal entry. Let's do that in the next slide here. Okay, so the journal entry, cash increases 13,500. Common stock, well, there is a par value. Now, if there was no par on this, the entire, we see here 5,400 would go to common stock, but there is a par value. So we're going to record the par value of the common stock and separately the additional paid-in capital on the common stock. So the par value of the common stock, let's go back here, we see that the common stock, 300 shares, $10 par value. The common stock account goes up by 3,000. We want it common stock plus additional paid-in capital to go up by a total of 5,400. So the difference is what we plug into the additional paid-in capital account. So this 5,400 is what we have here, and this 3,000 that we put that is attributable to the par value, what we back out, and that difference of 2,400 gets recorded to additional paid-in capital on common stock. Let's do something similar for preferred stock. Preferred stock also has a par value. So let's increase the preferred stock account at its par value. Let's go back here to see what is the par value. The preferred stock has a par value of 50, and we issued 100 shares of the preferred stock. So the par value of the preferred stock is 5,000. And the difference, so the total amount of the 13,500 that we're allocating to preferred, you can say it's, look at this 8,100 as 5,000 going into the par value and the remaining 3,100 going into additional paid-in capital above par related to preferred stock. Okay, so let's put that additional 3,100 here. And again, the 8,100 is from there, and the 5,000 is what we have here. And this goes into the account additional paid-in capital, preferred stock. And now our debits equal our credits, and we've properly accounted for the cash proceeds of 13,500 for common stock and preferred stock. Let's take a look at a slightly different problem. Beverage Corporation issued 300 shares of $10 par value common stock and 100 shares of $50 par value preferred stock for a lump sum of 13,500. So here nothing is different. Now the common stock, we know the market value is $20 per share, but we don't know the market price of the preferred stock. So it's not actively traded. We don't know what it is. In this case, when we don't know how much to allocate to the two types based on market value, what we do is we say, well, we do know how much gets to allocate to the common stock. The difference, the incremental difference between what we received, the cash proceeds upon issuance, and the amount that goes to the common stock, the 300 shares times the $20 market price, that difference goes into the preferred stock account. So calculate the amount that goes into of the 13,500 that goes to common versus preferred, similar to before. We have common, 300 shares, multiply this by Remember, the market price, not the par value. The market value is what the stock is actually worth, equals 6,000. We don't know what the preferred stock is. So we have a total market value of 6,000. So let's allocate the entire 6,000 to common. And the remainder of, or in other words, the difference between the 13,500 and what we allocated to common goes to the preferred stock. Let's record that journal entry in the next slide we see here. Okay, so the company receives 13,500 cash. We're going to put 6,000 towards total common stock, but remember, common stock has a par value. So we increase the common stock account at par, 300 times 10, same as before. Now we're saying 6,000 is the total market value of the common stock. So subtract out the par value to get additional paid-in capital on the common stock of 3,000. We have preferred stock with a par value, so record the par value of the preferred stock directly into the preferred stock account. We have 100 shares at $50 per share par value. And the amount that is left over, we would call this a plug number. The 13,500 minus 3,000, the additional 3,000, and the 500, that remainder of 2,500 goes into additional paid-in capital preferred stock. What happens if stock is issued for something aside from cash? Well, the general rule is record the stock issued for services or property other than cash at the fair value of the stock that was issued, if that's known, or the fair value of the non-cash consideration, whatever that stock is being given up for. If we know the fair value of that item, then we record it at that amount, whichever one is more clearly determinable. Let's take a look at an example, and we're going to look at the three possibilities of what might be determinable. Marlowe Company issues 10,000 shares of $10 par value common stock for a patent for Marlowe Company. Let's first assume that Marlowe cannot readily determine the fair value of the patent, but it does know the fair value of the stock. Well, clearly what we're going to do is we're not getting cash, so our debit's not going to be to cash. What is the company getting? The company is getting a patent, so we increase the patent account, and we don't know exactly how much that patent is worth on its own, but it's given up for stock with a fair value of 140,000, so we can assume that patent is worth about 140,000. Common stock is being given up, and that common stock does have a par value. It's a $10 par, and we're giving out 10,000 shares. So that's the amount that we're putting into the common stock account at par, but then we're also going to use an additional paid-in capital above par account. So the amount that we receive, the amount above the par value, $40,000, is going to be recorded directly into the account additional paid-in capital common stock. Let's take a look at another situation. Marlowe cannot readily determine the fair value of the stock, but it determines the fair value of the patent is 150,000. Well, what do you think is going to happen here? We don't know the stock, but we do know the patent, so we record the patent at its fair value, 150,000. We record the common stock at its par value. We do know that. We have 10,000 shares at a $10 par value per share, 100,000, and then we record any difference into the account additional paid-in capital common stock. And that's just the difference between the patent's fair value and the par value of the common stock. And then the third possible option is that Marlowe cannot readily determine the fair value of the stock or the fair value of the patent. So what do we do then? Well, we come up with the best possible estimate of a market price for whatever we can. And in this case, the company says, best we can do to come up with the price of the patent is to hire a consultant and use, how do we value anything, the discounted expected future cash flows. And that gives us a present value of 125. So therefore, we assume the patent has fair value of 125,000. Again, common stock at its par value, and the difference The $25,000 difference, of course, gets recorded to additional paid-in capital common stock. How about the costs of issuing stock? Companies incur significant costs for the underwriters, the investment bankers, accountants, and lawyers, printing costs, and taxes. How do we account for these direct costs? This is important. We should make sure that we're writing down the costs of issuing stock are recorded as a reduction to the account additional paid-in capital. So this is not an expense. It would make sense to think that we would call this brokerage expense, investment bankers expense, accounting legal fee expense, but it's not. We reduce the amount of additional paid-in capital. Finally, we're turning to preferred stock. Some features that are often associated, but again, not always associated with preferred stock. There's typically a preference as to the dividends. Preferred stockholders would typically get their dividends before common stockholders if there's a shortage of cash. What is available would go to preferred before common. Similar to that, preference as to assets in the event of liquidation. Some types of preferred stock, and it would be stated on that stock certificate, some types are convertible into common stock. Some types of preferred stock are callable at the option of the corporation. Remember, to call means to take it out of the market and take it out of the hands of the existing stockholders. So if the preferred stock is callable, the company can say, all right, we're ready to give you the cash for your shares, and we're going to buy it back from you. And preferred stock, again, is often non-voting, meaning that the stockholders often do not have the right to vote for the directors of the company.